Let us continue with module number 10, that is Fibonacci retracements. These are price levels derived from the Fibonacci sequence, which is a mathematical pattern found throughout nature, from flower petals to galaxies, and they appear with remarkable consistency in financial markets. Let us understand what is Fibonacci retracement. In an uptrend, price rarely goes straight up. It rallies, pulls back, and rallies again. The Fibonacci retracement levels help you identify where the pullback is likely to find support. The key Fibonacci levels are 23.6%, 38.2%, 50%, and 61.8%, and also 78.6%. Each represents how much of the prior swing the pullback has retraced. The 23.6% level is a shallow retracement that occurs in a very strong trend. The 38.2% is a moderate pullback. The 50% level is the psychological halfway point, not technically a Fibonacci number but universally watched. The most important level is 61.8%. It's called the golden ratio. This is the deepest retracement that still keeps the trend intact. In strong uptrends, the 61.8% retracement is the last defense of the bulls. When price bounces from 61.8%, especially with a bullish reversal candle and volume dry up, it is one of the highest probability buy setups in all of trading. 78.6% is the last line of defense. If price breaks below 78.6% on high volume, the trend has most likely reversed. Do not buy expecting a bounce. The uptrend is broken. How to draw Fibonacci retracements? Drawing Fibonacci correctly is crucial. The most common mistake is using the wrong swing points. For a bullish Fibonacci retracement, start from the most recent significant swing low and drag to the most recent significant swing high. Let your charting platform draw the levels automatically. For the best results, use these 5 steps. 1. Identify the clear swing low. 2. Identify the clear swing high. 3. Wait for the pullback. 4. Watch price at the 38.2%, 50%, and 61.8% levels. 5. Look for confirmation, like reversal candle, volume dry up, oversold RSI, or confluence with horizontal support or a moving average. Really powerful. When the 61.8% Fibonacci level aligns with a horizontal support and the 200 SMA, 3 different tools pointing to the same price level, the probability of a bounce there is very high. Fibonacci extensions tells you how far the move will go after the reversal. The 127.2% extension is your profit target. The 161.8% extension, the golden extension, is your primary target. Book 30% of your position at 127.2% and another 50% at 161.8%. Let the remaining position run with a trailing stop. Now let us learn the major chart patterns that signal large directional moves in module number 11, that is chart patterns. These are the formations that price creates over weeks and months. They are reliable because they represent some psychological battles between buyers and sellers. playing out the same way across different markets, different eras, and different instruments. Head and shoulders is arguably the most famous chart pattern in all of technical analysis, and for good reason. It has one of the highest reliability rates of any pattern. The structure: left shoulder, a high followed by a pullback; head, a higher high followed by a pullback to roughly the same level as the first pullback; right shoulder, a lower high, failing to reach the level of the head. The neckline connects two pullback lows between the shoulders. The signal: when price breaks below the neckline with above average volume, that is the sell signal. The right shoulder on declining volume compared to left shoulder is a critical confirmation that buying momentum is failing. Target: measure the distance from the neckline to the top of the head. Project that distance downward from the neckline breakout point. That is your minimum downside target. Inverse head and shoulders is the mirror image and is one of the best bullish reversal patterns. Left shoulder low, head at a lower low, right shoulder at a higher low, then the head. Neckline break upward with volume equals buy signal. Some of the strongest multi-month rallies in Indian markets have started with inverse head and shoulders pattern. Double top and double bottom. Double top is the M pattern. Price hits resistance twice and fails both times. The second top on the lower volume than the first is the key confirmation. Buyers are weakening. When price breaks below the valley between the two tops, the neckline with high volume, the pattern is confirmed sell. Double bottom is the W pattern. Price hits support twice and bounces both times. The second low on lower volume than the first means sellers are running out. When price breaks above the peak between the two lows, the neckline with high volume, the pattern is confirmed one of the most common and most reliable bullish patterns in Indian markets. After major corrections 2016, 2019, 2020, Nifty formed classic double bottoms before launching into multi-year bull runs. Learning to identify these patterns can literally change your wealth trajectory. Continuation patterns are brief pauses in a trend where price consolidates before resuming in the original direction. They are excellent entry opportunities for trend traders. Ascending triangle. Flat upper resistance with rising lower support. Strong buyers stepping in at higher and higher levels. When the flat resistance finally breaks, the breakout tends to be explosive. Bullish continuation. Descending triangle. Flat lower support with falling upper resistance. Sellers selling at lower prices each time. When flat support breaks, bearish continuation. Bull flag, one of the most powerful and reliable continuation patterns. After a strong vertical move up, the flagpole price consolidates sideways to slightly down in a tight, orderly pullback. The flag. This represents low volume profit taking, not genuine selling. When price breakouts of the flag with volume, the next leg up begins. Target equals the flagpole length added from the breakout point. Critical rule for all continuation patterns. The breakout must occur with volume 1.5 times or more above the 20-day average. Without volume, treat any breakout as suspect until proven otherwise. Pattern trading rules. 5 rules for trading charts patterns successfully. 1. Always wait for the breakout. Never buy in anticipation. Enter only when price closes outside the pattern boundary with volume. 2. Calculate your target before entering. If the risk reward is less than 1 or 2, skip the trade. 3. Set your stop loss before entering, just inside the pattern. 4. Never force a pattern. If you have to look very hard to see it, it is not there. Valid patterns are visible to any experienced trader immediately. 5. Trade patterns with the higher time frame trend. A bullish pattern in a long-term downtrend fails more often than not. Trade with the tide, not against it. Let us add advanced candlestick patterns to your toolkit in module number 12, that is advanced candlestick patterns. The 3 candle confirmation patterns that professional traders use daily. These are higher reliability than single candle patterns because they require more time to form, meaning more market participants are involved. 3 candle confirmation patterns. 3 white soldiers. 3 consecutive large green candles, each opening within the previous candle's body and closing near its high, represents sustained aggressive buying over 3 sessions. Very bullish after a downtrend or consolidation. Volume increasing across all 3 candles is the confirmation. 3 black crows. 3 consecutive large red candles, each opening within the previous body and closing near its low. Relentless selling over 3 sessions. Very bearish after an uptrend. Volume increasing is confirmation. 3 inside up. Large red candle, small green candle inside the red body. Forming a harami followed by a large green candle that closes above the red candle's open. Buyers taking over from sellers. The third candle must close above the first candle's opening price for confirmation. 3 inside down. The mirror image. Large green, small red harami, large red that closes below the green's open. Sellers taking over. Both 3 inside patterns are high reliability reversal signals used by professional candlestick traders. Rising and falling 3 methods. Rising 3 methods is a 5 candle continuation pattern. Large green candle, the trend candle, 3 small red candles that stay within the range of the first green, the consolidation. Then a large green candle that breaks above the first candle's high. The trend is pausing to rest before the continuing upward. Bullish continuation. Following 3 methods is the mirror image. Large red, 3 small greens within the red range, and then large red breaking below. Bearish continuation. The key to both patterns is that the 3 middle candles stay within the range of first candle. If they break outside, it is not a valid 3 methods pattern. Candlestick quick reference. Print the reliability scorecard from module 3 and keep it near you while charting. After 3 months of daily practice, looking at charts every morning for 15 minutes, you will recognize all patterns instantly. Pattern recognition is a skill built through repetition. Candlestick pattern quick reference. This slide is your cheat sheet. All major patterns, their signal type and reliability rating at a glance. Print this. Keep it on your trading desk. Refer to it every time you analyze a chart until the pattern becomes the second nature. Remember the golden rule. No candlestick pattern works in isolation. Always confirm with the trend, the key level, and the volume. Three factors together equals high probability. One factor alone equals a guess. You now have all the individual tools. Module 13 shows you how to combine them into a professional 3 time frame system. Module number 13 is multi-time frame analysis. This is how professional traders actually trade, not by looking at a single chart but by aligning multiple time frames before any entry. This module will dramatically improve the quality of your trade setups. The 3 time frame system. Professional traders use at least 3 time frames. The weekly chart for overall trend direction, the daily chart for the specific setup, and the 1 hour chart for precise entry timing. Weekly chart, the macro trend filter. Look at the weekly chart first every time. If the weekly chart is clearly bullish, only take long trades on the daily and hourly. If bearish, only consider shorts or stay in cash. Never trade against the weekly trend. Daily chart, the setup identification layer. This is where you find the pattern, the indicator signal, and the key level. The specific trade idea lives on the daily chart. 1 hour chart, the entry precision layer. Once you have identified the setup on the daily, zoom into the 1 hour chart to find the exact candle and price to enter. Tighter entry means a tighter stop loss, which means a better risk to reward ratio. The top-down approach. Start wide, zoom in, weekly for direction, daily for setup, hourly for entry. Never reverse this order. Never enter a trade based only on a 5-minute chart signal without checking what the daily and weekly say. Multi-time frame in action. Let me walk you through a real-world example of how to use 3 time frame analysis. Step 1 is weekly chart. You check Reliance Industries on the weekly chart. Clear uptrend, higher highs and higher lows for 6 months. Price above 50-week and 200-week SMA. RSI at 58 bullish zone. Decision, I will only look for long setups. Step 2, daily charts. You drop to the daily chart. Reliance has pulled back to its 50-day SMA after a strong rally. A bullish engulfing candle formed yesterday right at the 50-day SMA. MACD just crossed above signal line. Volume was above average on the bullish engulfing day. Setup quality high. Step 3, 1 hour chart. You zoom into the hourly chart. You see a small bullish flag forming just above 50-day SMA level. Volume dried up during the flag. Entry, buy on the breakout of the flag top. Stop 1% below the 50-day SMA level. Target previous daily high. Risk to reward approximately 1 to 3.5. Three time frames aligned. Entry is precise, stop is tight, risk reward is excellent. This is how professionals trade. Systematic, multi-layered confirmation, not gut feel. Time frame conflicts and what to do. Time frames do not always agree. Here is how to handle conflicts. Weekly bullish plus daily bearish. This is a healthy pullback within a larger uptrend. Do nothing. Wait for daily to turn bullish before entering long. This is actually the setup you want. The weekly trend will resume. Weekly bearish plus daily bullish. Dangerous territory. A rally in a larger downtrend, often called a dead cat bounce. High risk if you buy here. Avoid long trades. Reduce position size. All time frame conflict. All time frames conflicting. The chart is in chaos. The correct position size is 0. Stay in cash. Wait for clarity. There will always be another trade in a cleaner setup. The most underrated skill in trading. Knowing when not to trade. The best traders in the world are not always in the market. They wait for the moments when all the odds align in their favor. Then they act decisively. Patience between setups is as important as skills in executing them. Final module, let us combine everything into a complete rule-based trading system. Module 14 is building a trading system. Building your own trading system. This is the culmination of everything you have learned in this course. 14 modules of tools and concepts coming together into one systematic, repeatable framework. Let us build your edge. The complete trade checklist. Before any trade, every trade you must answer yes to all 7 of these questions. This is your gatekeeping system. Question number 1. Is the weekly chart trend aligned with the direction of my trend? If no, skip the trade. Question number 2. Am I trading at a significant support or resistance level? Or in the middle of nowhere? If the latter, skip. Question number 3. Is there a candlestick pattern confirming the setup? If no, wait. Question number 4. Is volume above average on a signal candle? If no, treat as a weak signal. Question number 5. Does RSI support the direction? Is MACD aligned? If neither confirms, reduce size or skip. Question number 6. Is the risk to reward ratio at least 1 or 2? If my target is not at least twice my stop loss distance, skip regardless of how good the setup looks. Question number 7. Have I pre-calculated my position size so that my maximum loss is no more than 2% of my total trading capital? If not calculated, do not enter. All 7 questions answered yes. Enter with full conviction. 6 out of 7. Consider a half-size position. Below 6, skip. No exceptions. The checklist removes emotions from trading. The checklist is the edge. Position sizing, the most ignored rule. Most retail traders spend 90% of their time finding the perfect entry. Professionals spend 50% of their time on position sizing. Let me show you why. The formula: position size equals capital multiplied by risk percentage divided by the distance from entry to stop loss. Example: you have 5 lakh rupees. Your risk 2% equals 10,000 rupees per trade. You want to buy Nifty futures at 22,500 with a stop at 22,490 at a 10-point stop. Position size equals 10,000 divided by 10 equals 1,000 units, or one lot of Nifty futures, since each lot is 75 units, approximately 5,600 rupees at risk, well within 2%. The 2% rule means that even 10 consecutive losses only cost you 20% of your capital. You survive, you learn, you improve. Most retail traders who blow up their accounts are risking 20 to 30% of capital on single trades. One bad trade and they are wiped out. Building your trading plan. A trading plan is a written document, not in your head, that defines exactly how you trade. It has 7 components. First is universe, which instruments to trade. Start with Nifty Index, deep liquidity, cash settlement, weekly expiry for options. One instrument masters is worth 20 instruments dabbled in. Second is entry rules, which setup trigger a trend. VWAP bounce plus RSI above 50 plus bullish candlestick. For example, be specific. Stop loss rules. Always a hard stop order placed immediately after entry. No mental stops, no exceptions. Target rule. Based on Fibonacci extensions, previous highs, or fixed risk reward of 1:2. Know your exit before you enter. Position sizing. Always the 2% rule. Calculate before every trade. Trade journal. Log every trade. Entry price, exit price, reason for entry, what actually. This is how you improve. Daily routine. Pre-market analysis from 8 to 9 a.m. Active trading from 9:45 to 1:30 p.m. Position management and exit review from 1:30 to 3:30. Post-market journal from 3:30 to 4 p.m. Consistent routine creates consistent results. The journey to profitable trading. Let me be honest with you about the timeline. Most people who are consistently profitable in trading today spent at least 2 years in serious study and practice before reaching that level. There are no shortcuts. Month 1 to 6. Study the scores. Paper trade only. No real money. Identify 10 patterns correctly on historical charts every week. Build your charting habit. Month 6 to 12. Start with 25,000 to 50,000 rupees of real capital. Maximum 3 trades per month. Journal every single trade. Goal: preserve capital and break even. Learning, not earning. Year 2. Refine your entry and exit rules based on journal data. Increase capital only when your system is profitable for 6 consecutive months. Add complexity. Multi-linked options strategies. For example, only after the basics are mastered. Year 3 and beyond. Scale capital. Focus exclusively on your best 3 to 4 setups. Build process documentation. Consistency compounds. The fastest path to profitability. Paper trade seriously. Start small. Journal obsessively. Review weekly. And never risk money that would change your life if you lose it. The market rewards patience and punishes overconfidence every time. This slide in your PPT is the pattern trading rules summary. Reference the earlier Module 11 script content for these slides. You have completed Technical Analysis, course number 3 of Fintamin Financial Education series. This has been the most comprehensive course so far. Let me give you your action items. This week, open TradingView. Set up a watch list of Nifty 50 stocks. Every morning for the next 30 days, spend 15 minutes looking at 5 charts. Identify trends, support, and resistance. Any candlestick patterns. Do not trade yet, just observe. Month 1, start paper trading. Use the 7-point checklist for every paper trade. Journal each one. After 20 paper trades, review your results. What setups worked, what failed, and refine. Month 2. If your paper trading is consistently profitable, start with real money at the smallest possible size. Always remember, technical analysis is a language. Fluency comes from immersion, daily exposure to charts, daily pattern recognition practice. The analysts I respect most have spent thousands of hours with charts. That experience cannot be replaced by theory alone. Course 4 is Futures and Options Foundations. Course 6 is the Institutional Trading Framework. VWAP, Max Pain, Gamma Squeeze, OI Analysis, both are available on fintamin.in. I am your financial guide from Fintamin. Thank you for your commitment to financial education. See you in the next course, which is course number 4.